You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey Dave, how you doing today?
I'm great, Nick. How are you?
I am doing very well, thank you, sir. Got another exciting episode here today on a gloomy podcast Friday.
But I was sure you were going to say it was sunny and warm down there.
April showers bring May flowers. I don't know what May showers bring, but...
Well, we're going to have a
June
lot
flowers?
of flowers. We're going to have so many flowers.
So today, speaking of flowers, Dave, let's talk about the market.
Yeah.
So today's episode is really kind of diving into how to navigate or think about market pullbacks and geopolitical risks and inflation and just general volatility when it comes to retirement, and kind of hopefully putting some things into perspective for investors and retirees, and just kind of thinking through, like, you know, what's your investment philosophy and how to combat what's happening right now versus what might be a long-term outlook, right? Sound like a decent plan?
Right. Yeah. Yeah. And, you know, so on the one hand, this seems like more important right now. You know, on the other hand, it's always been there. And what, you know, geopolitical risk has always been there.
Right.
That's kind of, you know, so right now here we are in this spring of 2024, and we've had, you know, a pretty severe escalation in the conflict in the Middle East.
Right.
With the Hamas attacks on Israel back in October, and then that's still playing out with Israel fighting in Gaza, and the whole world is kind of standing at attention as everyone's concerned this becomes a wider conflict, right?
Right.
And,
but, you know, like, just going back real quick too, I like your point about, like, there's always been something for us to worry about, like back to the, you know, the dawn of the stock market. There's those cool charts that go back to like the beginning and just point out like the major things that were happening that everybody was super worried about. And yet the market just, you know, amazingly kind of keeps on going up. But during that time, and it's not to diminish what's happening during that time, I think there's a lot of, you know, justified fear and panic, but it's not necessarily, you know, something that's going to affect things in the long term, right?
Right. So, you know, conflict in the Middle East certainly has been in the nightly news since as long as I can remember. And being somewhat of a student of history, I know it goes back, you know, to the dawn of recorded history, more or less. Right. So
well before the stock market.
in its current incarnation, it goes back at least to the 1940s. But if it wasn't a conflict for a while in between there, it was mostly because there were strong colonial and other forces in the region that kind of kept it under wraps, right?
Right. Mm-hmm.
So this is nothing new. And at the same time, we've got the ongoing war between Ukraine and Russia, and that's not really anything new there either.
Right.
But, you know, it's particularly worrisome right now when, you know, we feel everybody's kind of on edge about politics domestically, and we're seeing these issues play out in our own Congress. Are we going to support the Ukraine? Are we not? Are we going to support Israel? Are we not? We've got protests on our college campuses that I don't remember anything during our lifetimes. You know, we all have heard stories about what went on in the late 60s on American campuses with protests for the Vietnam War. But you know, this seems to be approaching that level, and you know, it's hard for me to say. I wasn't there in 1967, 68, 69, but certainly seems to be getting that level of attention anyway.
Yeah, for sure. And, I don't want to diminish what's going on and, obviously the loss
Mm-hmm.
of human life and everything. But when, if you're just focusing on the impact of the market, you have to kind
Right.
of set some of that stuff aside. Right. And I love this
Right.
chart from Clearnomics that we'll put in the show notes that just kind of goes over those last, 6 or 7 major events geopolitically, and then what happened as far as the market returns versus the days since that event happened. And it's kind of a mixed
Right.
bag. But what is interesting to me is mostly up, which probably isn't surprising because the market is mostly up, right?
Mm-hmm.
But also, the ones that are negative really had more to do with other things going on than necessarily
Right.
the conflict itself, right?
Right. So this chart, just so our listeners can kind of play along, basically shows several different global geopolitical events and what the market did 3 months after, 6 months after, and 1 year after.
Mm-hmm.
And just to pull a couple of them, at the beginning of Russia's invasion of the Ukraine, the market was down 5% 3 months after, and 3% 6 months after, and 7% 1 year after. But remember, that was in the middle of 2022 when what was really going on with the markets was interest rates were rising
Right.
and inflation was out of control.
Right.
And you can tangentially link like the invasion of Ukraine with some of the inflation fears, but not the root cause of the extreme inflation we were seeing at the time.
Exactly.
So the market was negative during that period, but it didn't really have much to do with Russia and Ukraine. Iran drone strikes against Saudi Arabia a couple of years ago. The market was actually up 3 months after that, down 6 months after that, and then positive by 11% a year later. Um, the Russia's annexation of the Crimea, that was a pretty scary thing while it was going on geopolitically. Didn't affect the market at all in terms of negative impacts. The market was up 3 months, 6 months, and 13% 1 year later.
Mm-hmm. Yeah.
Um, one of my favorites, because I dealt with this a lot in my early career, was 9/11, and the market had been up 3 months before that and was up 6 months after that, but was negative 17% a year later. Well, that I still have people. I still had people in like 2010 telling me that they had lost a whole bunch of money after 9/11. Well, no, it wasn't 9/11. 9/11 was bad, but 9/11 did not affect the markets nearly as much as the popping of the dot-com bubble and the collapse of earnings from tech companies, the collapse of
Right.
values of tech companies. So,
Mm-hmm.
it's funny because 9/11 is so seared in our brain as a national tragedy, a big event that we will never forget.
Right.
The biggest, most impactful event of its type in our generation, for sure. Um, that's what sticks in our memory, and we link what happened in the markets to that day. But the day the market reopened after 9/11, it was every stock on my screen was red that day, and I had one of those monitors with 1,000 stock tickers on it, except for Krispy Kreme donuts. But that's a story for another day. But it was definitely an impactful event. But 3 months later, the market had recovered from that, and then continued its downward march afterwards based on what was going on in the greater economy.
Right. I think big picture wise, it really just seems like, well, it doesn't seem, I mean, factually, you can't predict what a geopolitical event is going to do or
Right.
not do to the market. And so the first thing you should do is stop trying, right? If you are
Right.
trying, stop trying.
Yeah.
And just remember like why you're invested, what your goals are. If you're a long-term investor, this stuff can be, you can see fluctuations and volatility because of it, but long-term it really shouldn't affect you. And the goal is to stick with your plan and not necessarily, I don't want to say not worry about it, but try not to let it affect your decision making, right?
So every day that you're an investor, you're taking geopolitical risk. And like so many risks that we talk about in finance, it's not the things we know about. It's not the current situation that we need to worry about. It's the thing we haven't thought about, or the thing that we never would think about, or a sudden change in the status quo that will affect things. But what we know about the conflict in the Middle East, what we know about the situation with Ukraine and Russia right now, is all priced into the markets.
Right.
So I guess long way. I always think of do you remember the movie Dr. Strangelove?
I do not.
Oh, you need that. Okay, well, you need to see the movie Dr. Strangelove.
Now I got my weekend homework.
Its subtitle is How I Learned to Stop Worrying and Love the Bomb, right? And I always think of that when I think about geopolitical risks in the market. At a certain point, you just have to embrace the fact that that risk is always going to be out there and is part of why investing pays off. If everything was a sure thing, if there was no risk, stocks would have the same return as treasury bills.
Right.
There'd be no risk premium to the markets.
Exactly. Yeah.
So
we touched a little bit on inflation, Dave, but it seems like inflation is all we hear when it comes to the market lately. Following the Fed's footsteps, does Greenspan's not there anymore, but that just reminds me, is he carrying the briefcase or not? I don't know what the current Fed president, what his
Jerome Powell, what his tell is.
Yeah, exactly.
What Nick's alluding to is all the media would watch to see certain things about Alan Greenspan when he exited the Fed meetings as a clue as to what they were going to decide. And I think one thing about the current Fed, and I think this is to their credit, it might take the fun out of some of it for the media, but they really try to be more transparent now. Like, don't guess about what we're going to do. We're just going to tell you,
right?
And you don't have to it was a whole industry of Fed followers who would parse every word that they said. Like, did they say "the" 6 times in the first paragraph? It might tell us something. And now they just basically say.
I was just going to say, I think that they've done a really great job of it, which is interesting because all along they've kind of said, hey, this is where we're at. This is where rates are. And we're going to keep them here until, we see signs that say we can lower, and they haven't seen those signs yet. So it shouldn't be all that surprising, right?
Exactly what they should be doing. Why would we want the Federal Reserve to say we are going to lower interest rates in September when they have no idea what the data is going to look like between now and September?
Right. Yeah.
I'm picking a day. I don't, but, they're going to be data dependent as though that's news, they should always be data dependent. But
yeah, absolutely.
My
but that doesn't
on it, I guess.
I mean, that doesn't change the, all of the people out there kind of playing the game of, okay, well, they should reduce rates and we're going to, make our investment strategy based on that, which obviously we don't recommend, but not everybody's playing the same game out there, right?
Well, yeah. And, the market is really just a big, the sum total of everyone's more or less predictions about what's going to happen. And so, you've got at the beginning of the year, the market had kind of priced in the idea that we'd see 6 or 7 rate cuts by the end of this year. So trying to predict what that data was going to tell the Fed to do. And that here we are, 4 months after that. And now, the market's kind of got 2 to 4 rate cuts priced in. Because economic data was stronger for most of the first quarter than expected, and inflation has proven a little more stubborn than expected. So maybe that data is going to tell the Fed that they can't lower rates until really late this year.
Yeah. It's an ongoing thing. And I think, if the cautionary tale is don't pay too close attention to it, because
No.
again, it's one of those like, this is what's happening right now in the moment.
Yeah.
But the more important thing is, do we get the right policy where we get inflation where we want it to be long term, is much more important than whether or not we have 6 rate cuts this year versus 4 or 2, right? Or 0, for that matter.
So when it comes to thinking about risk and volatility, whether it's geopolitical risk, inflation, interest rates, the trajectory of the economy, I think we agree the most important thing is to just recognize that in the short run, it's going to be what it's going to be.
Mm-hmm.
And which means it's going to be unpredictable. The market is going to be volatile. In the moment, it's all going to seem scary and new, and always feels worse than whatever came before it. But in the long run, the market grows. The market grows because the economy grows. The equipment wears out. People keep having babies. Technologies improve. Productivity improves. The market grows with it.
Right.
So when we're talking about retirement planning and we're talking in terms of decades, whether you're pre-retirement or post-retirement, we're generally talking in chunks of years. You need to just tune out that day-to-day volatility and accept it.
Yeah, and I think too, just from like the financial planning standpoint of having a solid financial plan, which involves not just like your investments and how they're doing, but also like, are you doing the other things? Do you have the emergency fund? Do you, are you budgeting properly? Are you prepared to potentially scale back or / have extra cash available if things go the opposite direction? Do you have proper insurances? Like all of that stuff leads to putting you in a solid position so you can withstand what could potentially be a longer term downturn when we get to that point. And I say when, because we will at some point get to that point, right? Like it's inevitable that we're going to have a bear market.
Oh yeah. We quote Daniel Crosby a lot, but one of my favorite lines of his is that correction in the stock market is as regular as your birthday, because we tend to have a 10% pullback once a year on average, going back to before World War II. So you just need to know that that's part of the game. And every time it happens, the media is going to treat it like it's the newest, scariest thing that's ever happened, even though it happens as regularly as your birthday.
Right.
So,
well, and that is a great segue into our last chart here, which is the annual total returns and pullbacks, right?
Yeah, we've gotten a lot of mileage out of this chart. Yeah, yeah. But it shows that most years are positive. Of course, we know there's negative years in the market, but going back to the 1980s, you can pick your year. Looking to pick one I like here. 2023, just last year, the S&P 500 closed up 26%, but at one point during that year, it had dropped 10% from its most recent high.
Right. And just looking at this chart, you can't have those positives without the negatives, right? Every single year there's a drawdown, and usually it's greater than 5 and probably averages closer to 10-11%.
Yeah, it's
in terms of like what the negative at some point during the year is going to be. And the point is, you can't get those larger returns every year if you don't withstand the
we negative. Know. Yeah, since the early 1980s, I think I had looked up what the average drawdown would be not long ago. I think it was around 13% was the average.
Yeah.
But you can pretty reasonably say that the long-term historical return of the S&P 500 is right about 10%. But in every year, there's a drawdown of close to 10% during that year.
Right.
So that's those are pretty good, easy, nice round numbers to kind of hang your hat on. And it's all about expectations, right?
Right.
If you know that that's going to happen, then you can mentally prepare yourself for it. And but it's not just being mentally prepared, like you talked about a minute ago. Like what we really want is people to be resilient in the markets, right?
Mm-hmm.
We want you to be strong enough to stay there. That's one part mental fortitude, which is just, accepting the fact that you're going to see this volatility and you're going to have to ignore it, and it's going to feel cruddy when you do it, but that's the fact. And then the other part is financially being prepared. Be mentally prepared, be financially prepared by having that emergency fund, by spending within your means, by knowing what you would do if the hot water heater died tomorrow and it doesn't involve selling stock.
Right.
Yes. I mean, at the end of the day, it shouldn't involve credit cards and it shouldn't involve the stock market.
Right. Exactly.
So if you can put yourself in that position financially, then putting yourself in that position mentally is easier.
For sure.
Yeah.
Absolutely. 100%.
So,
yeah. Well, very good, Dave. This hopefully was helpful to our listeners. And to our listeners, if you have any questions, feel free to shoot us an email at info@srbadvisors.com. We love to hear what you think of the episodes and love to hear what other topics you might be interested. Dave, it has been a pleasure,
Nick.
My friend. Until next time.
One of my favorite topics. Yeah, I'll talk to you later.
This is a Zedia Media production.